Hello traders, welcome back to my YouTube channel. Thank you so much for clicking. Kindly remember to subscribe, like and comment down below. Hello traders. So welcome to another video. So in this video, actually I'm going to outline some of the ICT concepts that are very crucial in learning what trading is all about. So actually the concepts I'm going to discuss here are very key in understanding these concepts. So when you understand these key concepts that I'm going to outline, you are well on your way to understanding the entire ICT concept. So to begin with, we'll begin with the specific times of day. So the specific times of day is actually, in my opinion, the most crucial part of these concepts. I'm not saying that the rest of the concepts are not crucial, but I'm just saying this is the foundation of the entire concept. So specific time of day and also day of the week, depending on your style of trading, it becomes important to outline which time of the day you want to be trading in, and if you'll be focusing on a specific time or day of the week for that matter, because specific time of day is important for those traders who are either scalpers or day traders, and then the day of the week could be more important to those who are short-term traders or swing traders. So actually we're going to be looking at 4 specific times of the day. So we have the Asian session. So Asian session is important in the sense that it frames the entire day direction. For example, if you have a daily bias, so if you already have a daily bias, then it means that the Asian session will mostly show the liquidity that could be used to drive the market either higher or lower. For instance, in this day, we had a bullish bias. So with our bullish bias, we are saying that Asian was creating sell side liquidity that was later used and was taken out in order for this market to go higher. So this market went higher after taking out sell side liquidity of the Asian session. You can see this period here, the liquidity was taken out. Yes, it dropped way below, but we're still seeing that liquidity was taken out. And then you have London Open. So London Open is very crucial actually when it comes to defining your daily range, because we are taught that that London Open actually forms high or low of the day majority of the time. So you're going to be looking at an example where London formed low of the day or high of the day for that matter. So it forms high or low of the day majority of the time when you have a clear bullish or bearish daily bias. So when you already have a daily bias, then London Open will form high or low of the day majority of the time. So but for New York can also form. So we are saying in this day New York actually formed the low of the day. So it can also form the low of the day or high of the day, depending on if we have hit any higher time frame key levels. So in this day we hit a higher time frame key level right here. I think it was a weekly order block. So once we hit it, we see this response, then the market returns to this imbalance, then it drives higher. So we already had a bullish bias, then the market now hit that higher time frame level, and then during New York, so the time comes first before even the price. So and then the market, we are seeing it go higher. So the next important concept you're going to be looking at is high or low of the day. So as I've outlined, in this day London Open formed the high of the day. So we are saying that actually this day we were bearish on the daily chart. So that's why we are saying that the market dropped aggressively after that, and that's why we were anticipating this high to be formed during London or New York. But we're saying that this day it formed during London. So This is an example where New York, of course it was the previous example where New York formed low of the day. So we also have specific days of the week. So depending on your style of trading, as I mentioned, you'll be interested in maybe day of the week compared to maybe somebody who trades during the day or day trading or scalping will be more interested in the specific times of the day. So for maybe short-term traders or swing traders, they will be more interested in knowing the specific day of the week that is high probability. So for instance, we are taught that Monday, Tuesday and Wednesday are the high probability days to hunt for setups. So we can see in this example that actually Wednesday formed the low of the week. So in this example you're seeing Wednesday forming the low of the week, and Monday and Tuesday actually did not, it basically just consolidated. So this is essentially a consolidation, and then the low was created on Wednesday, and then you see the market now run higher to close the week. So this is an example where you have a Wednesday low of the week after taking out some sell side liquidity down here. So another very important concept that we are taught is the order block. So the order block, actually in this instance, this was the instance where Wednesday formed the low of the week. So we already have a narrative that we're expecting a low of the week this Wednesday, and then we are now seeing the market now create this candle, and then it breaks above. So once it breaks above that candle, that is a confirmed order block. Then now the market comes to retest it, but that is after hitting some key level here during a high probability day, and you see the market now drive higher to take out this buy side liquidity. Another important concept, of course, is liquidity. So liquidity is when the market now uses either lows or highs to move. So for instance, in this day, we're seeing that the market took out these lows from Tuesday, then the market now turned, breaking this high, which is a market structure break, and then it moves higher from there, taking out that liquidity. So even if before it moved down here, you're seeing that it took out this buy side liquidity. Another very important aspect or concept is the fair value gap. So the fair value gap actually shows dynamic price action. It shows you how aggressive the market is moving away from a level. So in this example, we are seeing that the market had already come down from that level and it was going higher. So it is showing us how aggressive the market is moving. And once it leaves this fair value gap, we usually want to see it being retested and then the market continue higher. So I've come to find out that there are only two reasons that the market moves higher or lower. It's either to rebalance or to seek liquidity. So those are the two key things that you need to really focus on when you're determining the direction of the market, or if you're determining either where the market might be drawing towards. So finally, we have a concept which is premium and discount. So in this concept, actually, we are seeing that we have a range. So we have a predefined range. This is a range high, and we have a range low down there, and then we have a midpoint, which is the equilibrium. Then now below the equilibrium, we have discount. Then above the equilibrium, we have premium. So this concept actually help us to position ourselves in the right manner, because when you're positioning yourself, maybe in a trade setup, you want to position yourself where it is optimal. So this concept helps us to position ourselves in an optimal area where we can get a good return on investment when we are executing. So thank you so much for watching. That is the concept overview. Thank you. Thank you so much, guys, for watching. I hope this video has been helpful. If you enjoyed this video, don't forget to like, subscribe and comment. Also let me know what kind of content you want to see or any suggestions you have. Thank you.